Good morning and welcome to our latest podcast. I'm Derek Barrow from Santander Asset Management, and I am joined today by our Global Head of Macro Tactical Asset Allocation and Alpha, Hayden Davies. Good morning, Hayden.
Morning.
Okay, so let's kick off with our first question. We've seen a lot of volatility in markets lately, and retail investors are asking what on earth is going on. Can you summarise the major events for us, please?
Well, of course, it's been a story of volatility all year. I don't think there's been any let up really since the beginning of the year. And I suppose in a nutshell, what it boils down to is inflation. So equity markets can live with higher inflation. We've obviously been very lucky to have low inflation for the best part of the last 25 years or so. But they don't like inflation accelerating and surprising. And the story of the year has been that inflation has just surprised people. So at the end of last year, I think the consensus amongst economists was that inflation in the US at the end of this year would be 4%. And we're on course for around about 8%. And similarly, economists were expecting UK inflation to be about 4%. And of course, inflation is likely to be about 10%. So there's been a huge surprise that's caught markets unawares. It's also caught central bankers unawares. And they were a little bit late raising interest rates last year when they should have. And so they've been playing catch up this year. And that has meant that bond yields have pushed higher as well. And the constant debate in the markets, which is why we've got this volatility, is when can central banks call it a day and stop? And every time the markets think maybe central banks have done enough, maybe there are signs that inflation is peaking, central banks reply, no, we've still got more to do. And that's why we've had this volatility, this occasional breaths of relief in the markets that maybe the worst is behind us in terms of those interest rate rises. And then central banks saying, no, we've still got more to do, and we may very well have to engineer a recession.
Thank you. So you've talked about the rate rises there, and there's much talk of the Bank of England having to increase rates faster and further following the recent mini budget. So I guess two questions. Do you think we'll see an emergency meeting and raise rates early? And if so, how much do you think the Bank of England will raise rates in the short and medium term?
So the Bank of England had a tough job even before the mini budget. It should have raised interest rates earlier, but that's true of a lot of central banks globally. Everyone was waiting for the US Federal Reserve to raise interest rates first, and they didn't really raise them until the end of last year, the start of this year. I don't think there will be an emergency meeting. The Bank of England's made it very clear it doesn't really want to do that. It would rather wait to see exactly what the numbers in the mini budget are, and that's why we're all waiting for the report from the Office of Budget Responsibility. But it has to be said that the macro picture has certainly changed because of the mini budget. I think 2 days before the budget, Kwasi Kwarteng, the Chancellor, had told the Bank of England off for allowing inflation to get out of control. And then in the mini budget, he announced £45 billion he was pumping into the economy. So the Bank of England needs to work harder now to get inflation under control. That goes without saying. And the markets, and certainly our view, are the same, that the Bank of England at its next meeting in November will have to raise interest rates by an eye-watering 1.5%. That's how much the macro picture has changed. In terms of what the markets are expecting for how much higher interest rates could go, generally the consensus amongst the markets in market pricing is that bank rate, which remember at the moment is 2.25%, could reach about 5.75% by the end of next year. We actually think that Bank of England will have to raise interest rates to 5.75% earlier than the markets are expecting. We think that rates could reach that level by the spring. That's how much the Bank of England is behind in terms of getting inflation under control and how much the macro picture has changed because of that mini budget.
Excellent, thank you. So bearing all the things you've just discussed, how are Santander Asset Management position portfolios at the moment? And what are you looking out for before you would make any significant changes of position?
So all year we've been pretty despondent about the outlook for markets. Previous year was a pretty easy year to be an investor. You just invested in equities or bonds and you made money. This year was always going to be more challenging after a very good 18 months previously. Because central banks were behind in terms of controlling inflation, we've expected bond yields to rise, and we thought that would lend a sort of difficult backdrop to equity markets as well. Obviously, the Ukrainian war has made things even worse. So we've been very pessimistic on the outlook for both equities and bonds. We think there will be a recession, certainly in the US, the start of next year. And Europe may very well be in a recession already because of particularly the spike in natural gas prices. So that's a very difficult environment, certainly for equities. We do think that maybe bond yields are starting to reach levels at which maybe the worst is priced in. We're not quite sure we're there yet, so we're still underweight bonds, but we're starting to look at these levels and wondering, well, it might not be too long before we might want to move to a more neutral position or even start buying bonds at these levels. And usually it's the case that bond markets bottom a couple of months before equity markets bottom. So we wouldn't be expecting equities to bottom until early in the new year at the very earliest. So looking to sort of move to a more neutral position or a positive position on bonds, and then we'd be looking for signs that the recession is possibly upon us and the worst is over and the worst is priced in, and we'd move to a more positive stance on equities.
Thank you, Hayden, for your detailed update. So thank you for listening to our latest podcast. The views expressed in this podcast are the views and opinions of Santander Asset Management UK and do not constitute investments or financial advice. If you want to explore more of our views and insights, please visit our website at santanderassetmanagement.co.uk. If you require guidance or advice, we would recommend you contact your professional financial advisor. Thanks once again for listening to our podcast, and we look forward to speaking to you again soon.